Pretty much the first thing that you hear about when you're first getting into investing is, diversify your investments. Don't put all your eggs in one basket. But how diversified do you really need to be? Can you be over-diversified? Because you can certainly be under-diversified, but can you be over-diversified? Today in this video, we are going to discuss pretty much everything about diversification when it comes to your investments. And the first thing that I want to talk about is, what is your investment goal? Are you seeking higher returns, or are you seeking lower risk? Because generally speaking, risk and return have a correlated relationship. The more risk that you take, the more of a higher return you are more likely to make. And the opposite is true. If you take very low risk, then generally speaking, you are going to get very low return as well. So you need to determine for yourself what is going to be the right amount of return and the right amount of risk that you are willing to take in your investment strategy. A lower risk investment might be able to reduce your volatility or the fluctuations in the value of your investments, whereas a higher return investment might be able to get you that higher return, but it's going to be a lot more volatile. And different asset classes will perform differently at different times. So for example, if stocks happen to be declining, then perhaps bonds are increasing at that time, and vice versa. The different asset classes, they perform differently over time, they perform differently in the short term, and they react differently to different market situations. So for example, a few different asset classes that you could have include stocks, you have bonds, you have real estate, and you simply just have cash. All of these different things will have different reactions and will perform differently in different situations. And they also might have different kinds of correlations between each other, which means if stocks are declining, maybe real estate is not declining the same way that stocks are. Or if real estate is, declining or holding steady, stocks might be going through the roof. It just depends. So different asset classes will have different correlations, and therefore when you're developing your diversification strategy, you need to realize the correlation between those and make sure that you accept a correlation that is going to be tied into your individual risk tolerance, because that's really what it all comes down to, is your individual risk tolerance and how you create your portfolio around that risk tolerance. Investing is a really big part about what this channel is about, what On Cash Flow is about. And so if you are liking this video so far, please don't forget to like and give it a thumbs up. I really appreciate it and it really helps me out. And at the same time, consider subscribing to the channel, because every single week I am putting out new information just like this on personal finance, on investing, on saving money, and I just know that there's something that I can help you with. I'm currently putting out videos every Tuesdays and Fridays at 8 a.m. Pacific Standard Time, so anytime on those days, feel free to watch a new video. But getting back to diversification, let's first talk about what the risk is of being under-diversified, because one of the biggest things about being under-diversified is that it creates unnecessary risk. So you're taking on risk that isn't really necessary, because sometimes the returns that you get by being under-diversified are not going to be high enough to offset the amount of risk that you take by only being invested in, say one thing or a very few amount of things. For example, one individual stock, it might be able to return a lot more than the entire S&P 500. The S&P 500 being 500 of the largest publicly traded companies in the United States. So one individual stock, even within that S&P 500, might outperform all the others, maybe even exponentially. But you can bet that that one stock is going to have a lot more fluctuations in its value than the entire S&P 500 combined, on average. And the amount of return that that individual stock might bring over the entire S&P 500 index, that amount of greater return might not be worth how much that individual stock fluctuates in price or fluctuates in perceived value. And that's why, in order to solve under-diversification, especially as an individual investor, one of the best things and one of the easiest things you can do is just invest in broad-based index funds, because these broad-based index funds allow you to get into them with very little money upfront, sometimes even a $0 minimum investment, and they allow you to invest across so many different asset classes and so many different companies, so many different whatever, very easily. You can be invested in 5,000 different things by only actually investing in $100. So your microscopic share of all of those companies might be super small, but you're actually very well diversified just because you chose to invest in a broad-based index fund. Whereas if you took that $100 and you had to buy an individual stock, there's not too many individual stocks, first off, that you would be able to buy with that $100, so you're limited there. And you're literally putting all of your money into one company, and so you're going to see those drastic fluctuations, even if you think that that one company can outperform the entire market itself. On the other side, we actually do have over-diversification. And if you are over-diversified, then you potentially will lower your returns, maybe even substantially. If your asset classes have different correlations, then they could be used to offset their returns. So if you have, one asset that is going down and you have one that is going up, that could bring them closer to the middle to having lower returns, closer to zero. And so if you're invested in every single thing, not all asset classes, not everything as an investment is created equal. Not everything will return you, substantial returns. And so if you are over-diversified and you pretty much buy every single thing available in the investment world, then your returns are actually going to be lower. Because you are invested in everything. So while one thing is going down, the other thing is going up, that is going to bring you, closer to your baseline. That is going to bring you closer to zero. So yes, being over-diversified might be a problem just as much as being under-diversified is as well. And I talk about this all the time because not everyone's portfolio is going to be the same. How much diversification that's going to be right for you, it's entirely individual and it's entirely up to your risk tolerance. What allows you to sleep at night, but what also allows you to get a amount of return on your investment that is going to be good enough for you. So take as much risk as your tolerance allows while also allowing you to be somewhat diversified. Not under-diversified, but not over-diversified as well. And it's really hard to actually, put a number on that. Like, this is what being, in that perfect middle ground looks like. I can't really say that because, my middle ground might be a lot different than what your middle ground is. For example, I invest in a total US stock market index. I invest in a total US bond index. And I invest a little bit in a total foreign stock market index. But my split between those asset classes, those might be too risky for someone, or it might not be risky enough for another person because our individual risk tolerances will differ. So I wish that I could give you one straight answer on this, but the answer is there is none. Now, one theoretical proposal for the perfect amount of risk to reward is what's known as the efficient frontier. So in the perfect theoretical world, you would be invested along the efficient frontier. And I'll actually throw a picture on there for you just so you can see it. So if you know anything about, finance, if you ever studied finance in college or anything like that, you would probably have learned about the efficient frontier. Now in the real world, what I think is the best action, at least for me, and it possibly could be for you as well, is to don't think that you need to invest in every single thing. Because as I said before, not everything is a good investment. Not everything is going to return enough, return on investment for you. Some things are going to be too safe. Other things are not going to be safe enough, just depending. And at the same time, try to keep your portfolio simple and only invest in things that you actually understand. Because if you invest in things that you actually understand, you're going to feel a lot more confident about them. You're going to keep investing and invest more and grow your net worth. So that is pretty much the biggest secret to diversification that I have found. And if you want to continue your journey on learning about investing and growing your net worth, then make sure that you watch this video that I created called How to Achieve Financial Independence in 10 Years or Less, because it is a blueprint to becoming a master of your cash flow and to grow your net worth exponentially. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.